What you mentioned before, vertical versus diagonal spreads. What's the difference between the two?
The diagonal spread is one of my favorite strategies. It really is because it combines both ideas. So when you have a straight call, a call is basically the most aggressive strategy. You're long a stop, you're long an option, you're bullish, obviously, you're very bullish. You have a massive target on it because you think it's going to just rip higher because you didn't sell anything against it. So that's one strategy, right? A vertical spread is more conservative because you're picking a call option, let's say out 30 days, and then you're selling a call option against it for the same expiration date out 30 days. So for that 30-day period, you're capping your upside basically, like we talked about. You have a sale option on top of it, which basically caps whatever that is. So if you buy 100 strike call and you sell 110 strike call against it, if it goes to 111, you don't make that extra dollar because you're short a call essentially at 110. Now, a diagonal spread, what that does is it allows you to test drive the call option. That's what I like to call it. It's like the option test drive, because what you're doing is you're not using the same expiration date. What you'll do is you will go out a month, just like you normally would. Let's say you buy a 1 month call option, right? The $100 call option. And now what you'll do is you'll say, you know what? I think it's going to go sideways this week. I think it's eventually going to break out. This week, I'm a little bit more bearish. I think the market's kind of tired, but you still like this particular stock, right? That's your problem. That's your dilemma, right? So what you do is instead of going out a month on the sell side, you just go out a week. So what you'll do is now is you have the 1 month option, which is your main leg or your anchor leg. And then what you do is then you go out a week. And let's say instead of the 120s, instead of the 110s, maybe do 105. Because you don't expect it to really move around too much this week. Here's the good thing about this. You do the 105s out to this Friday. When Friday comes along, and let's say it's at 104.5, that option is going to expire worthless. You took in a very small credit. You didn't take in a larger credit like you normally would if you went out a month because of time decay, right? There's less time. But now what you can do is you could roll it up. If it's at 104.5, you're no longer going to sell a 105 strike. Now you're going to do the 110s for the following Friday. And then let's say next Friday rolls around, you could do the 115s. And let's say the following Friday rolls around, you could do the 120s and on. And what you're doing is you're just rolling up your short calls and you're collecting a premium every single week. And what you're essentially doing is you're lowering the cost of your trade. If that original 100 strike cost you $500 and you're taking in 50 to $100 a week in credit, now your trade is essentially free. And now worst case scenario, the stock goes to 110 on Friday, right? You're still going to have a profitable trade because your anchor leg is still the 100s. You're still going to have a profitable trade. Only thing is you won't make as much money as you wanted to. You would have to close out that position. Maybe you're only up 10, 20% on the contract. Who knows? But I could think of worse problems to have than be up 10, 20%.
No, right? Yeah. Actually it looks like Philip had a good trade that he got out of too soon. $20 puts when the market went down, went up to $800 a couple of weeks ago, sold too early. Better get out now. Who's going to buy this? So who's buying such an expensive put when the market can't even catch a bid? Then
you know what? I never really worry about that. A lot of people, I've had people ask me that before. Well, who's on the other side of the trade? I don't care. You know what I mean? It's good to know, it's good to look at volume and open interest to see where institutions might be hedging and what's going on. But there's really no rhyme or reason sometimes why someone would take the other side. It could just be a market maker trying to make the spread. Who knows? It could be a hedge fund maybe hedging a position. It could be someone doing something else, part of a larger trade something more complicated that you have no idea what's going on. So I never really let that bother me. If someone wants to buy a put that's that expensive, that's on them. You know what I mean? They might just be hedging, or they might just have a more bearish stance than you. Who knows?